All right, welcome back, everybody, to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. And we talk about current events. We talk about what we're hearing. We're talking about what we're experiencing. This is a real life, down to earth, day to day, what's going on in the real estate, multifamily real estate world in the Carolinas. And every week we talk about things that are happening to us or for us, and hope that we can provide a little bit of insight into our experiences and help you make some decisions of your own, or at least maybe change some of your perspectives based on what's happening in the current market and what we're experiencing. This week we're talking about what are we predicting and what are we hearing is going to happen into next year, and actually what's kind of happening right now. I had a phone call with a broker earlier today, and we were discussing some deals that he had coming out to the market, and asked if, kind of what Tim and I were working on. And I told him, honestly, man, we got like 5 or 6 refinances going on right now. We're focusing on our operations. We're really making sure we're stabilizing the assets that we currently have, and maximizing the opportunity there. Because you can add more by not adding more. You can make more money by not adding more units, right? So that's what we've been really focused on, and hitting a number of refinances. I mean, we bought a lot of deals in the last 3 years, at 2-3 years, and a lot of those loans are coming due, and we're working through a lot of refinances right now. So had some conversations with the broker and just kind of relaying a little bit of that message. So Tim, what have you been hearing? You do more phone calls with brokers and our acquisitions, and what are you hearing on the rumblings from the brokerage side?
I just ignore those guys. I don't talk to them anymore. No, I mean, kind of the same thing, man. It's been a slow year. It's been a quiet year, and I got to be honest, like, depending on which broker you talk to, I think you're getting different messages. Like one broker we talked to, right? He's like, "Hey, I think next year is going to be great. I think it's going to be awesome. Transaction volume is going to be up." You talk to another broker, and he's like, "Man, I'm seeing." I'm seeing the beginnings of 2008, 9, that kind of thing but this time in the commercial world. So I don't, I think you got to kind of read between the lines and the tea leaves a little bit. Maybe it's a little blend of everything, right?
Mm-hmm.
And maybe we're going to see a whole lot of transactions next year because there's a whole lot of stress in the market, and it's 2008 and 9, and and a lot of those distressed deals are going to sell. Who knows? But I, what I do know is that things are going to have to pick up next year. They're going to have to open up and pick up a bit next year. So whether that's distressed deals or just straight up deals where guys are like, I don't want to refi it. I want to sell it. And you know what, that brings up a good thing right there that we hadn't talked about was, I think you're going to see some people that, because their debt's coming due, like you said, they're going to be like, I don't want to do this anymore. And I just want to sell it. So they're not distressed, right? They're just fatigued, if you will.
Yeah.
And they're like, I can make a little profit and move on with my life, so I'm going to do it. Right.
I dabbled a little bit, but this isn't really for me.
Yeah. And hey guys, like, if you're in that space, I'll just say this right now. If you're in that headspace, no hard feelings. Like, I don't blame you. This has been I've told people this a lot over the last 3 months. This has been a really, really, really tough year. And
I think a lot of those fatigued buyers that are kind of half in, or sellers, or operators, I should say, that are half in, half out, they're getting tired because there's absolutely no cash flow.
Right.
None. And they're like, why am I doing this? Like, this is awful. I could have put my money in the stock market and made 30%, or Bitcoin last year and made 30%, and I'm making nothing, right? So I think you're going to see a lot of people that are willing to just sell it to get their money out of the deal. Now, the question is, are they underwater or not?
Right. Yeah. You're definitely going to see some of that, right? I mean, especially folks who got into this thinking, hey, I'm going to buy 1 deal or 2 deals and it's going to change my life, immediately, that kind of thing. I think there was a lot of that going on. So I think we're going to see some of those folks that have come to a reality over the last year or so, and they're going to sell. And honestly, one other group of sellers that I think we may see, is I think you're going to see some folks who got into syndications who have made a little money, have a little money in their bank account and now can start doing JVs or just buying smaller properties on their own, right?
Hmm.
I think you're going to see some of those folks say, I really don't want to do the syndication thing anymore. Let me go buy that 10, 12, 15 unit that I can buy just myself or with just a buddy, a partner. And you may see some of those 60 to 100 unit properties that everybody was so hot and heavy over. I think you may see some of those start to exit, and you'll see those guys pivot into slightly smaller deals.
Yeah, I think a lot of that, it's part of kind of why we haven't really talked about this a whole lot yet, but kind of pivoting our business model just a bit on the deals that we look at and how we underwrite them. I mean, because over the last 12, 18 months, there's been no value to be added, right? I mean, yes, we did our value add plan and we increased the value of the property, but a lot of that value add and equity was wiped out by increased costs, right? There's a lot of properties that we have that the rents are pretty flat, expenses keep going up. We're uptick in delinquency and vacancy. Those types of things are really, really, really killing the bottom line. And what we're looking at now, and a lot of it's been the feedback from our investors, is like, hey, like this equity growth, these heavy value add equity growth deals, like they look great on paper, but the last 2 years, they really haven't come to fruition. A lot of it because the equity's been wiped out from the increased expenses. And a lot of investors, at least my own investors, are saying, hey, like I want more cash flow. I want stabilized deals. I want less risk. I want cash flowing deals. And ultimately, what that's going to come down to from Tim and I really is retraining or re-advertising to our investor pool and saying, here, this is what we're hearing as feedback. This is some of the things that we're learning from our current investors. Here's what they want and what they're looking for. So we're going to have to pivot a little bit in order to provide something and stay relevant in the syndication space.
Yeah.
There's a couple guys I follow on Twitter, and they only buy with 5-year stabilized fixed debt. And they only advertise like 10, 12% IRRs and, 6, 7% cash flow. And it's super conservative underwriting. There's not a lot of refinances. It takes a lot of risk out of the table. You don't have to rip the Band-Aid off and get the rents up. You can step people up over, if you're $500 under market rate rent, you could probably do $150 or $200 rent bumps over 2 or 3 years instead of try to increase to $500 year one, right? So like changing that business model changes your cash flow because you're not taking on vacancy and renovation costs and on all that other kind of stuff, right? So kind of looking at deals a little bit differently now so that we can provide something to our investors that they're looking for. And ultimately, the deals have changed. I mean, with a lot of value add, with a lot of deals that have lost value, being able to buy them at a price adjusted market rate and have a 5 or 10-year horizon, it's going to make your underwriting look different. And I'm okay with that. Like from the operator side, it removes and reduces a ton of stress from our side of the deal. And our team, right? I mean, we think about the operation side of it and our team, and they get fatigued with constantly having to push rents out and constantly deal with difficult conversations with investors to increase market rate rents. And we're feeling the effects of that, right? So trying to pivot there a little bit and make it a little bit more sustainable in the long run is definitely a goal of ours.
Yeah. And you bring up a really good point, and you're starting to see some things in the market. I just got back from a conference in Chicago early last week. And one of the things that I kept hearing at that conference was we're seeing a lot more interest from pref equity. So, I mean, and when you dial that back a little bit, when you peel that onion back, what you're seeing is it's like pref equity. If you think about it, those guys, they're not worried about the speculation. They want the 10%, right? Pay me the 10%, basically guaranteed. I'm not worried about that speculation of a 10, 20, 30, 70% equity slice, right? They're like, hey, I'm going to bring it in. I want 10% annually, and we'll just call it a day. And that's kind of like what Tim's talking about there with like, hey, I'm buying on stabilized debt. It's going to be a 12, 13, 14% IRR, but it's going to pay this every year like clockwork, right? And, barring some big event, barring something major happening in the market, When you put something on stabilized debt, you're basically saying, hey, I know what my costs are for the next 5 years. And then on top of that, I'm buying in today at this rate as a hedge against inflation, right?
Hmm.
So you're doing all those things. Quite frankly, guys, you're doing all those things that real estate was meant to do.
Yeah.
Um,
I
right?
mean, that's the thing, my God, I feel like a broken record, but I've had this conversation so many times in the last like 2 weeks of the Fed is going to reduce rate again.
Yeah.
And by reducing rate, you're increasing inflation. Inflation is a good thing for real estate investors because rents go up and, rents go up, right? And yeah, obviously your expenses go up as well. But the biggest key factor here is you're locked in to long-term stabilized debt. So, if rates have been trending down, right? But if they keep reducing the Fed and the Treasury thinks that the long-term outlook on the economy is not good, the rates are going to go up. And if you can lock into low rates or a decent rate today and hedge about rates going up to 200 basis points or something like that in 2 or 3 years, then you're doing really, really well. Like that's when you start to make some serious cash flow and the values of your properties go up because your gross income is going up, right? Now, obviously, I know everything's valued off of net operating income, but if you can operate your deal and keep a lot of your costs the same or similar and control your expenses and your rents continue to go up, there
Yeah.
that's a recipe for success.
Yeah. Yeah. And the whole pushing rents thing, I mean, believe me, it's great. It's an awesome thing, but at the end of the day, I think we got to get back to what you're kind of talking about there, which is like really, really dialing in on the expense line, right? And we always one of the things that was always a popular idea for a while before we started seeing $200 and $300 rent bumps annually year over year was, hey, but you know what? Doesn't cost me any money? Saving on expenses. Um,
Hmm.
and I save $1 and I make two, essentially, right? And so it's interesting that we've a lot of people have lost sight of that, right? Is like, hey, who gives a shit if I'm running 45% expense load when I'm pushing rents 200 and $300.
Hmm.
But at the end of the day, that's not going to last forever. It's not sustainable, right?
Yeah.
Um,
But that's one thing that we do as a management company very, very, very well is manage our expenses. I mean, obviously I have been working through the budgets for 2026 and
yeah,
looking at our budgeted expense ratios and what we expect our rents to go up to. And, a lot of our properties are operating in the mid to upper 30% expense ratio range,
yeah,
right? Now I know when I go to buy something, I would never underwrite it to that low depending on the property, depending on the location. There's a lot of factors there, right? But we're operating them on an expense ratio basis as well as we can. But it also goes to show that we've already increased our rents significantly, right? Because it's a ratio. So if your top number goes up, your ratio goes down, right?
right,
And as long as your denominator stays the same or relatively close to the same. And that's what we've done over 2 to 3 years. I mean, we
right,
bought them and they were operating around 40, 46, 47%. And now they're down into the low, mid to upper 30% range.
right,
And as I keep sending Tim over these budget files, and it's like I don't really see anything else we could do in terms of expenses, right? And
right,
it's okay. Well, so then now we're focusing our efforts on top line growth because we have loss to lease and vacancy and delinquency that we can clean up and increase our income. And all of those things will, obviously increase our revenue and further reduce our expense ratio. I wouldn't say that it's not probable that by the end of 2026, our expense ratios and budgets for 2027 would go down to the low 30% range.
yeah. Tim, I think you're bringing up something that I think a lot of people miss, and you and I have talked about this a lot. Um, and you said at the beginning of the call, adding without adding, right? So adding without adding more, I guess, is another way to say it. But there's probably, guys, like if you look at it, there is probably money to be made on the portfolio that you already have. If
Mhm.
you go if you go look at that loss to lease or delinquency number,
Mhm.
right? And then figure out, hey, if I just went and focused on collecting that
Yep.
or collecting 75% of that, right? Like what would that do to my numbers? What would that do to my expense ratios? What would that do to my cash flow, right?
Yeah.
And
Yeah.
and so So you look at like me and Tim, for example. You know, how many properties we have? 20 something properties, right?
We manage 26 of them,
Yeah.
and we have like maybe 30.
Yep. So just what we manage ourselves, right? Just what we manage ourselves. If we take that 26 and let's just say that each property's running, 3% delinquency, right?
Mhm.
Let's say we can just cut that to 1.5%. We just go gain an extra 1.5%. You average that across that portfolio, man, that's substantial cash flow.
Mhm.
Not only cash flow, that's substantial value, right?
Yeah.
So that's where like in the last year, I mean, I'm not going to lie to you. Over the course of this year, we have gone after acquisitions, right? They just have not
Mhm.
worked. They haven't worked out. It's been a really rough year for acquisitions. But during that year too, we've been looking at it and saying, hey, if we just focus on this, there's more to be had. Just
Yeah,
within what we already own, right?
yeah, for the acquisition side of things, it's I don't need this deal, and it's really gotta change my life if I'm gonna buy it, right? Kind of with our perspective changing on value adds and analyzing deals on in-place cash flow and, with the amount of distress in the market, I can be patient. To buy I don't need to buy another deal. I don't need to make, you know, a value add deal work so that the seller can get out of the deal and not lose any money. Frankly, I don't care about that anymore. This is where I need to be at. And if this isn't where they want to transact at, too bad. I don't really care. And one of the one of the lines that I like using is like, Mr. or Mrs. Broker, our track record and our portfolio. I think there comes some weight and some value there of saying, hey, these guys, when they make an offer, they close on the deal. And how important is it to you to get out of the deal, especially as, debt is expiring? Do you want somebody that's going to string you along for 90 days and then ultimately not close on the deal? No, not at all. So like when we say something, we mean it. Dennis asked, what are you seeing with the insurance market, stabilizing or still unstable? There's been a big change in the insurance market, a big softening in the insurance market. We shopped our property insurance portfolio um, this summer, and it renewed in August, and we had a 30% reduction in our insurance costs on our master insurance policy. And the feedback from the brokers is that they expect it to continue to soften into 2026. So I'm hopeful that either the insurance will stay the same or maybe even have a slight reduction. I'm not really counting on a reduction, and I am still underwriting to a 5% increase. But I'm hopeful that the insurance market is mostly stabilized. Now, the property insurance, we definitely got a reduction, right? A 30% reduction.
Yeah.
Where we're not seeing a reduction is our general liability. There's been an increase on the general liability insurance. So, your assault and battery, your umbrella coverages, your
Yeah.
general liability coverages, like anything. I just call all of that general liability, right? All of those prices have continued to go up. I think there's been more and more insurance claims on the liability side than the property side over the last 2 years.
Yeah.
Um, you know, with the exception to Hurricane Helene that came through like a year and a half ago now.
Yeah.
That was obviously a 10,000 year storm, which now they're not modeling it to happen to again for another 10,000 years, which I can tell you is past my lifetime. I'm hopeful that the insurance will just kind of stabilize and stay the same at this point and not continue to go up.
Yeah. I think the only kind of caveat to that, right, is like your lender. Um,
Oh, lender requirements. Oh, yeah,
yeah,
lender
yeah, 'cause
requirements are increasing. Like, so like, when when you get like your auto insurance policy, there's state minimums, right? Where you got to have, what is it, like 250, $100,000 liability coverage, $100,000 something, whatever the coverages are on an auto policy. Well, as we're refinancing now, a lot of these, the agency lenders, Freddie and Fannie, are making us increase our general liability coverage from $250,000 up to $1 million in coverage. And I can literally tell you that increasing your assault and battery coverage from 250 to $1 million doubled our insurance policy on the general liability side.
yeah,
Now, as a percentage basis, The general liability of our total insurance is a much smaller percentage, but you can see that the total absolute dollar amount is going up drastically on a percentage basis and a dollar amount basis. So what we saw in savings on the property insurance side were slightly reduced and offset by the increases in the general liability. That's why I'm saying I'm hopeful that the general liability will either stabilize or start to see a little bit of a reduction next year and keep insurance costs generally the same.
Yeah. So, and I think that's, I mean, that's one of the things that's kind of frustrating about some of this too. Like, like Dennis, you work really hard, right, to go get those insurance costs down and do the things you can do. And then you're on stabilized debt, like we talked about at the beginning of the show. And you're like, okay, we're good. We're finally starting to see some things. And then your stabilized lender that has agreed to lend to you for the next 5 years comes in and goes, you know what, we're changing our insurance requirements on you. And it's going to add, $2,500 to your annual premiums. And you're like, okay, great. There, appreciate that. So, it's always something, right? I mean, it's always like a moving piece. And I think the more and more you do this, the more and more you're going to realize, like, hey, it's always something. You just got to
always. Every time we turn around, it's a new problem. It's, oh my goodness, when does it end?
So like going into 2026, do I think deal volume is going to pick up? Yeah, absolutely. It has to.
Transactional volume will absolutely pick up.
Yeah, 100%. Now what's the motivator for that? What's the catalyst for that to happen? I think it's going to be a bunch of different things like we talked about, distressed buyers, fatigue buyers. I think you have legit distressed sellers, fatigue sellers. And then, just general transactions where people are ready to sell for, no fatigue, no distress at all, just because it's time. And then the other thing is, guys, like I think you're going into 2026. I think the good principles still apply. Like keep an eye on your expenses. I highly encourage you to not push rents as hard as you feel like you should, and look at it more as like, hey, I didn't get the $50 increase, but I saved the $2,500 to $3,000 turn cost, right?
Mm-hmm.
So be looking at that kind of thing, especially for guys who are on stabilized debt. And you still got a 3-year window. You don't need to be pushing rents right now, right? Focus on the cash flow. Focus on the expenses, right? And then the other thing I would say is just be prepared. Keep your reserves strong. Do all the good things that you're supposed to do when you own a property. Don't over leverage. Keep your reserves there, and keep an eye on the market.
So I think one of the difficult conversations you'll have to have over the next couple of years is that if we don't start to see a significant increase in the rents and our expenses stabilize, that investors are going to be upset that they're not getting distributions. But as an operator, I can tell you the most important thing is to make sure that there's cash liquidity in the reserve account, because you never know when there's going to be a change. Like the deals that we were talking about earlier, these are deals that were already refinanced into stabilized Fannie loans. Fannie came back a year after these have been into these loans now, and they're saying, hey, we reviewed your insurance and we need you to increase this, right? And when you do that increase, you have to pay that premium up front, and you have to have the money to do that. So, there's continual things that you're not going to expect. A good general rule of thumb that Tim and I like to use is $1,000 in reserves per unit. That is a pretty good rule of thumb to stay, to kind of weather any unexpected HVAC units that pop or increased insurance costs that you need to pay. Whatever happens, right? I mean, there's the other thing to consider is what is your insurance deductible? I mean, if you have a $100,000 insurance deductible and you only have $50,000 in the bank, it doesn't help you, right? Because you're not even going to be able to pay the deductible and get your property fixed. So, make sure that you're paying attention to those things. And, all of our properties have $25,000 deductibles. So we make sure that we have at least $25,000 to cover any insurance items that might come up if there's an insurance claim.
Yeah. And also, Tim, really good example. And the other way to look at that too is like, hey, if you got $100,000 deductible and you got a $50,000 of reserve sitting in the bank, what happens when you have $75,000 worth of damage? Right. So you got to keep that kind of stuff in mind. Right, guys?
There's a lot of moving parts. I mean,
Right.
and trust me, we're not perfect at it, and we
No.
understand it. And sometimes the reality of it is much more difficult to execute on. But you have to be aware of those types of scenarios and situations when you're making the decision to distribute funds or not.
Yeah. And and for those of you guys running syndications, I mean, I feel you. I'm right there with you, especially if you're running them the right way and you're doing all the right things. But but it's still a struggle because it's really, really hard. Tim and I are going through this right now. I mean, it's really, really hard to go back to investors when that refi does happen and say, "There's." I know there was projected capital return at the refi, but it's just not happening.
I mean, there's one loan we're working on right now. The initial soft quote was $1 million higher than what we think was probably going to actually close at in terms of proceeds.
Yeah, and if you think about this, Tim and I keep talking about this, is it's $1 million lower than where it was, and during this whole time, our RIT roll has increased.
Yep.
So really, the total value, the total spread there is bigger than $1 million if you think about it, because we've increased the NOI line this whole time, and but it's just, guys, it's just what it is right now with this lending market and the reserves that they're requiring and all these other good things. So
you got the landscaper outside.
yeah, man, can you guys hear that?
I just heard him walk by with it.
Actually, if I could show you out my window, they're not actually a landscaper. It's the guys cleaning the gutters. I thought they were coming tomorrow.
Oh yeah. Oh good. Yeah. All right. Well, hey Dennis, thanks. Have a great Thanksgiving as well, and appreciate you joining every week and asking great questions. Hope you learned something from this and take away something. If you're watching this later, I hope you guys all have a great Thanksgiving, and we will see you again next time.
Yeah. See you guys.